family? It's CJ Investing here, back at it again with another video on just covering articles that I find interesting and informative. I hope you do so as well. So let's get right into it. Three dirt cheap dividend stocks that are passive income machines. So you may have heard of these. They're nothing new. These industry leading businesses are inexpensive relative to their historic levels. The COVID-19 pandemic dramatically altered the way in which many people work. Today it's easier than ever before to have a side hustle, multiple freelance gigs, and even different revenue streams, all the while working from home. Even with the dawn of the gig economy, one of the most tried and true methods for generating passive income is through dividend stocks. No surprise there. Dividend paying stocks can be especially important during times of economic turbulence and market volatility because they provide income without the need to sell stock. In this vein, an investor doesn't have to worry as much about short-term stock prices. Starbucks, JP Morgan and Chase, and the Home Depot are three excellent dividend stocks that also happen to be inexpensive. Here's what each company a great buy now. So I own the Home Depot right now, and I'm thinking about adding JP Morgan to my dividend portfolio. Not really too big on Starbucks. I've never owned it before. I don't really go to Starbucks or too much. I'm not too big of a coffee person. I don't drink coffee anymore. So but I still think it's a great company to take a look into, invest into. Uncertainty is grinding Starbucks stock price toward a 52-week low. Starbucks stock is down 35% from its all-time high for several reasons, many of which are valid. Investors don't like uncertainty, and Starbucks has a lot of it. Howard is back as interim CEO, but we don't know for how long. Starbucks cut its share repurchase program, and we don't know the company's plans for the dividend. Starbucks has implemented several price hikes, which will be tested as inflation continues to rise. And finally, the Starbucks unionization issue is heating up. However, none of these issues take away from Starbucks' long-term investment thesis. The company posted record high revenue in 2021 and the second highest net income in its history after 2018. Starbucks remains one of the most powerful food and beverage brands in the world and the most recognizable coffee chain in the world. When you think coffee, you think Starbucks. The good news is that investors are getting compensated for all of Starbucks' uncertainty. The stock continues to trade at price-to-earnings ratio of just 21.8, well below its 5-year median price-to-earnings ratio of 29.8. That's quite a bit of a slump. It's also worth mentioning that although Starbucks cut its buyback program, it has yet to mention any altercations to its dividend program. Starbucks has paid and raised its dividend every year since 2011. Given the importance of the dividend and Starbucks' ample free cash flow, it would stand to reason that the company will simply eliminate share buybacks to free up capital to grow the business, but still pay and raise the dividend. That makes sense. Starbucks has a dividend yield of 2.5%. So a decent yield. They have room to grow. Okay, so the next company is JP Morgan. So number 2, the leading bank stock is simply too cheap to ignore. With a market cap of $386 billion, JP Morgan Chase is the most valuable bank in the United States and the third most valuable financial service company behind Berkshire Hathaway and Visa. I agree. JP Morgan stock currently has a PE ratio of just 8.6, excluding the brief pandemic. Induced stock market crash in 2020, JP Morgan stock has never traded at a PE ratio below 10 in the last 8 years. That's pretty incredible. You can't go wrong with investing in JP Morgan. It's one of the safest investments in the stock market, in my opinion. The stock may look cheap, but comments from CEO Jamie Dimon's annual letter to shareholders on April 4th signal that there are a lot of headwinds facing both the U.S. economy and banks as well. JP Morgan could face a slowdown in growth and potentially a prolonged period of lower return on equity, ROE. However, JP Morgan has proved through multiple economic downturns that it has staying power, given the inexpensive valuation at 3.1% dividend yield, which is a decent yield. JP Morgan looks like a great long-term buy now. I agree. Thinking about adding it to my portfolio one day. It's on my watch list already. So number 3 is Home Depot, and it can be a foundational stock in a diversified portfolio. As I said before, I already own this one in my Roth IRA. So shares of Home Depot are hovering around 52-week low, down over 25% from its all-time high. Yet zoom out and Home Depot stock is still up a lot from its pre-pandemic levels. I would say a lot of stocks are up from pre-pandemic levels. It feels like forever ago. But Home Depot benefited from a surge in do-it-yourself projects during the pandemic, as well as scorching hot housing market. However, rising interest rates are leading to higher mortgage interest rates, which isn't a good sign for the housing market going forward. The issue now is that both home prices and mortgage rates are high, whereas in 2020 and 2021, home prices were high, but debt was so cheap that people could afford new homes anyway. Pair rising interest rates with inflation, and Home Depot is in for tough comps in 2022. Despite the short-term challenges, Home Depot remains a powerful brand and a great dividend stock. Home Depot has never cut its dividend since paying it in 1987. So let that sink in and marinate for a little bit. That's a long time. That's before a lot of us was born. So that's pretty crazy. It would be a dividend aristocrat, which is an S&P 500 component that has paid and raised its dividend for at least 25 consecutive years. But Home Depot suspended dividend raises during the financial crisis. Home Depot stock has a dividend yield of 2.5% and a PE ratio of 19.8 compared to the 5-year median PE ratio of 23.3. Sit back and collect passive income from this diverse trio. Investing by equal parts in Starbucks, JP Morgan, and in Home Depot gives an investment average yield of 2.7%, which isn't bad at all. And exposure to the food and beverage industry, the financial sector, and the home improvement industry. What's more, an investor can rest easy knowing that no matter what the market throws at them, all 3 of these companies will likely remain relevant and probably grow to become a lot bigger in the decades to come. I agree. I don't think these companies are going anywhere, and they're going to continue to thrive no matter which environment that they're in. So those were the 3 stocks. I want y'all to take a look at them. Home Depot, HD, Starbucks, SBUX, and JP Morgan, JPM. So I just own Home Depot again, thinking about adding JP Morgan and Chase. You can't go wrong with that company. And I'm not really interested in Starbucks, but I know a lot of people that are, and I know that it's still a great company and not going anywhere. So all of these are 3 great options in different industries, as stated before. But I hope y'all check these out whenever I get some time. And I hope that y'all have a blessed rest of your day. Thanks for tuning in once again, and see you next time. Peace.